Alrighty. The July real estate numbers are in. I'm Riyad from Right at Home Realty.
Will Ellis from Right at Home Realty.
And I'm Sadiq Boodoo from Approved Financial Services.
I swear it seemed like just like yesterday we had this June talk about what happened in the real estate market, and here we are again, right?
Exactly.
So I'll jump right into the average real estate numbers for the market across the GTA. Total residential transactions were down about 47% from year over year. Last year we had about 9,300 transactions, and we're down to about 4,900 transactions for this year. Month over month, we're down about 7.3%. June of 2022, we had about 5,700 transactions, and for July, 5,200 transactions. So definitely a little bit slower over the summer months. Average selling price year over year, we're still up. We're up about 1.2%. Last year, $1,061,000. This year, about $1,074,000. Month over month, we're down 2.6%. June 2022 was $1,137,000, and July is $1,108,000. Now, total new listings, we're down as well, 4.1%. 12,500 listings last year and about 12,046 this year. Days of market still remain longer than usual, that we've seen over the last, 2 years. We're sitting about 29 days on market. So, Will, what are we seeing out in the Durham region?
Durham numbers are as follows. Sales are down 36.5% from July 2021. Listings are up 14% versus July 2021. Market is showing signs of balance versus a year ago, which is obvious. Days on market's now just at 15 days. Average price is starting to stabilize now. We're at 901, 412 for the average average price in the region. And Oshawa's showing an average of now just 765. So there's some opportunities there for buyers.
That came down quite a bit.
Yeah, some good prices now in Oshawa. And the market's showing some good opportunities if you're a buyer. And if you're a seller, you just got to be realistic in your price.
Nice. And Sadiq, what are we seeing out in the mortgage world?
Well, you know what? It kind of mirrors everything you guys are seeing in the real estate world, obviously, because they're so tightly connected. People are very, very hesitant to jump into the market. Pricing on homes is very difficult to determine. If that price makes sense, if it's value you pay for that is going to be supported by an appraisal. So we're seeing people kind of holding off. Even in the refinance arena, there's not a lot of activity there just because of the fact that people are hesitant. People are not certain if their values are going to come in. But what we are starting to see over the last week to week and a half is a lot more people seeking pre-approvals. And I would attribute that to the fact that I think that as we're seeing that these prices are normalizing, right? We're seeing, there's this expectation of prices drastically dropping, but we're not seeing that true drastic drop because prices are still higher than they were last year. We're just seeing a decrease in where it was over the previous months, right? So people who were anticipating that it's going to plummet and haven't seen that plummet that they were thinking are now realizing, okay, well, maybe it's just more of a flatlining of prices. So let me start getting that pre-approval going because maybe I'll hang on for a couple of months, but I want to know that I'm in a good position. The one thing that I am seeing is of those people that are now getting back and looking for pre-approvals, which is I look at as a lead indicator for buying activity, which it is. We are seeing a lot of people with very unrealistic expectations of prices. As recently as yesterday, someone that one of our team members was working with is looking to purchase a townhouse in Toronto with an expectation of a $450,000 purchase price. Yeah, that was our reaction too, right?
We'll buy 3 of them right now.
Yeah, I know exactly. Right? Like if you can find that for me, I will buy every single one right now without hesitation, right? Because I'll flip it tomorrow and double my price, right?
Exactly.
So there is a little bit of unrealistic expectation from some people trying to get into the market, and that expectation might be based on that's what their affordability allows them, and that translates to what they want. Reality is that does not exist. It's not existing right now, and I don't think we're going to see those prices at all. So the one thing I can say to people, if you are still considering buying, and I know you're out there, I know there's lots of people who still want that dream of home ownership, is don't try and time the market. Okay, what you should be doing is looking at your financial situation, preparing for that purchase, because the thing when you try to time the market is that ideal home that you would want to purchase might have just slipped right through your fingers because you're trying to get the best deal, not get the best value. Okay, so go for the home that you want, because a home is a home. Okay, that's what it's primarily for. So don't hesitate, don't wait for that. Don't worry about what the market's doing. You're buying a necessity, shelter, right? Figure out your financial situation and take action as soon as possible, because these things will go up and down. But over the long term, we've seen that houses have always been a solid investment, and beyond investment, you're satisfying your primary need of shelter. Make that your priority.
Words of wisdom right there.
Well, I've always said this, Sadiq, you're a very wise man.
So question for you, you talked about your pricing. Have you seen are mortgages now, what type of price point are people looking at? Is it like, is a lot of people under $1 million based on what you're seeing, or is a lot of people over $1 million?
So we're actually still seeing a mix of it, because we
Okay.
still have those prices that are, and I mean, realistically, the quantity of homes that are available under the $1 million mark is still a lot less than the ones that are above $1 million mark.
Yeah.
So we are seeing that there is, because of where the pricing is, majority of purchases are still hitting over that $1 million mark. There are some that are coming in below, but not in that great quantity. I think what people are adjusting to is the fact that these rates may not necessarily come down back to those 1.99 that we had before. Now we have seen a little bit of drop in the rates because the bond markets are what drives the fixed mortgage rates. Okay, when the Bank of Canada changes the overnight lending rate, that has a correlation directly to the variable rate, but not directly to the fixed rates. And as we've seen some decreases in the bond market, we've also seen that 5-year fixed rate come down a bit. So where they were at like the 539s to 549 rate, we're seeing them come down to the 519, 509. And in some cases, if you're doing like a high ratio purchase, they're into the back into the 4s, the high 4s, but at least it's not the high 5s.
Why are they coming down? Just due to the fact that they've increased the rates, the fixed rates are coming down a bit?
Well, it's because the bond yields have changed, right? And just like the stock market, the bond market fluctuates, right? And because the bond yields have come down, the fixed mortgage rates can come down because bond buyers are essentially asking for less return. Therefore, the lenders who are selling these bonds in order to generate the funds to lend out as mortgages can ask for less interest because they have to pay out less interest.
So talking about rates, September is the next anticipated hike. What do you guys think, predict, or what are you seeing?
Oh, well, it's anybody's game. If I had a crystal ball and I could tell you for certain, I wouldn't be talking to you. I'd be on a beach somewhere because I'd be filthy rich, right?
Yeah, that's right.
And my biggest decision would be what drink to have next. And if you can see from my tan, I just came from a beach, but
what drink would you have?
Only one of everything.
One drink. You got to work.
Yeah, no, I only have one drink, just one of everything. But reality is it's anybody's guess. I would say, looking at where inflation is, looking at where the economy is, it's kind of a little bit conflicting in my view. They're looking at inflation being still high, and the government's incentive is to bring that down. Again, from our previous conversations, this is artificial inflation. So nothing you do with interest rates is going to affect artificial inflation. What we have seen is gas prices come down over the last week and a half or so, right? So that will have an impact on the inflation rate, but is it enough that the government will put the brakes on any more increases? You know what? Logic would say yes, but the recent history with the Bank of Canada, in my opinion, logic did not overrule, right? They didn't proceed logically. I think the best course of action is to not make any more changes for the remainder of the year. Let these changes filter through the economy. Any changes to your overnight lending rate takes about 3 months to filter through the economy to see the true effect. We've never had that opportunity so far because these rate increases have been so quickly and by such a great quantity. I think they need to put the brakes on it. I hope that they do, but again, their logic versus everybody else's logic is not really lining up.
So have you heard talks of them I've heard people say that they are going to increase at least 1/4% or 0.5%. Do you think that, do you see that happening based on what you heard, or?
Yeah, you know what? I think the 1/4% is probably the likely one,
Okay.
because they've had big increases, so probably a moderate or small one now. You know, it is still likely that the 0.5% being kind of a moderate increase, but I think the fact that we went up, 75 basis points, going 25 now might be where they're looking at. Again, we've seen the gas prices come down. Nothing to do with changes in the interest rate. This is other economic factors around the world affecting it, but we're seeing that, so we might still have that chance. One of the really interesting things, and I actually want to look into this, usually when the government increases interest rates, we see an increase in the Canadian dollar, which affects our exports. We have not seen that.
Yeah, I was going to say
And
that.
what I actually believe is happening, and a little bit of research could probably prove this, I just haven't had the time to go into it, is I think the Canadian government is actually, while increasing these interest rates, is also still putting in a lot of money into the economy so that it keeps the dollar value low to support our exports. Because this change in interest rate is not having the effect on the dollar it's supposed to be, and historically has always had. And because we're not seeing that, I think there's some additional stimulus the government's not really talking about that they're putting into to keep the dollar where it's at. So I don't think they can afford to do that much more. So if they do change interest rates, it'll probably be that 1/4%, because their coffers are going to run low on being able to stimulate to affect the Canadian dollar, right?
Do you think there's going to be a recession? Like, I mean, with the fact that interest rates are high and inflation is high, a recession, in my opinion, doesn't make sense. But what do I know?
You know what? It's likely, because here's the one thing we know for a fact. When it comes to expenses, they keep going up, right? Despite everything, your property taxes have gone up. You've seen your utility bills go up. You see, everything else that you have to buy just to be able to operate your life at its minimum level has gone up. So the one thing that for most people out there, for those especially that are working that 9 to 5, that salaried or that hourly job, the one thing you have not seen is a correlation in your income going up to offset those changes, right? And because of that inflation, because of those changes and that lack of increase to your income, affordability becomes low, what that means then is people are now going to not buy the luxuries as often. They're not going to go out for dinners as often. They're not going to go and spend the money on the entertainment as often. They're not going to buy more clothing or the higher end clothing. They're not going to buy the things that bring them joy in life. They're just going to buy the things that they need because their budgets are now thinner. When that happens, consumer spending drops. And when consumer spending drops, it trickles through to every single part of the economy, because there's this concept of the multiplier effect, right? What is $1 actually worth in the economy? Because that $1 travels through many hands, right? And when you pull that $1 out, it might, if your multiplier effect, which is typically around 5 to 6 times, when you pull that $1 out, that means 5 to 6 other people are not getting that revenue.
Right? Yeah. Makes sense to me.
Perfect. That was very insightful.
Well, thank you, Sadiq.
So much.
You're welcome.
Well, we'll be back next month and we'll see what happened in the August numbers just before the fall market hits.
Exactly. Awesome.
Looking forward to it.